morning in progress.
Hey, hi everyone. We're just going to give a couple more minutes to let more people join our session before we get started. So we'll give about 5 more minutes to let more people join. In the meantime, feel free to grab yourselves a drink, get yourselves comfortable, and I'll see you guys in about 4 more minutes. Hi Fabian, welcome to today's webinar. So we're just going to give a few more minutes to let more people join the session before we get started. Today's session will be on Trendlines, channels, and liquidity traps. So if you have any questions throughout the webinar, feel free to let me know. Okay, I think we'll go ahead and just get right into it. Hello, can you hear me? Okay, great. So let's go ahead and just get right into it. So as I mentioned earlier, today's webinar will be on trend lines, channels, and liquidity traps. So this is the second part of our two-part series on support and resistance. But if you missed last week's webinar on support and resistance, just the first part, no worry, because we'll do a brief recap before we get into the new stuff. Okay. Excuse me. Okay, let's go ahead and get started. So I'm Melanie. I'll be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX Research and Equity Research in the years 2019, 2020, and 2021. Oh yes, before we get started, just a disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead an educational material only. This material is just the personal opinion of the authors, and the client's investment objective and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so here's our agenda for today. We're gonna do a quick recap for our first part of this series. We're just gonna be briefly going through pullbacks and overlap support and resistance, just so you are on track with whatever we're going through for today's webinar. After that, we'll get right into this week's session. So we're going to be talking about trend lines and what is considered a valid trend line and trend channel. And then we're going to be talking a little bit about liquidity traps and what exactly they are. Okay, just to double check, everyone can hear me, right? Because in my it says that my volume is a little bit low. So I'm just checking to make sure everyone can hear me clearly. Okay. If at any point throughout the webinar you can't hear me, just let me know in the chat. Okay, so let's get started with the recap from last week. So we're going to be talking about pullbacks first. So a pullback support is a strong level of support because it breaks out from a previous resistance level and price is now dropping back to visit it again. So a pro tip, when a pullback support lines up with a Fibonacci level, it is very powerful. A pullback resistance works well when it breaks a significant swing low and then starts pulling back to it. It's even better if there are multiple Fibonacci levels that line up with it. So we'll go through a few more examples in the coming slides, but you can see here in this GIF that we've included, we have a swing low here, swing low support, and this swing low support lines up nicely with this 38.2% Fibonacci retracement and also the 61.8 Fibonacci retracement. And so what happens is that we are expecting price to pull back or retrace back to the same level here. But once it retraces, we can also expect it to reverse off of it. Why? Because there is a large area of Fibonacci confluence because of the two levels that line up nicely. Okay, so let's take a look at another example. So here we have this red area. Price has tested this level 3 times with multiple swing highs in line with one another at the resistance level. So once price breaks the red area, it becomes a pullback support level, and we expect price to pull back or retrace this level, as you can see from the dotted lines here. Okay. So it's basically when price breaks out of this resistance or support, then it becomes a pullback support or resistance. Okay, here's another example. So here we have a multiple swing low support level. You can see these 3 arrows. So it's more of an area than specifically one level. But here we have a swing low support, and price actually broke out of this level over here. And once it breaks out of the level, it then becomes, instead of a support, it becomes a resistance. Why resistance? Because we're expecting price to pull back or retrace back to this level and reverse off of it. So obviously, once it reverses off of it, it becomes a resistance level. So that's what we are expecting it to do. Okay, so here's another example from an actual chart. So we have a swing low here, swing low support, and then price reversed off this level or bounced off this level, and it broke the swing low support, thus becoming a pullback resistance. So as I mentioned earlier, pullback because we're expecting price to retrace back to that level. So you can see ultimately this is exactly what happened after that. It retraced back to this level, and once it actually reaches this level and reverses off of it, then it becomes an overlap resistance, but we'll get into that next. So this is the before. It's a pullback resistance because we're expecting price to retrace back to this level, and here's exactly what we expected. Okay, so as I mentioned, we're gonna see what happens once price reverses off of this level. It becomes an overlap resistance level. So before it touches this level, it is pullback. Once it touches it, it's an overlap. Okay, so we're gonna explain it a little bit more over here. Okay, so an overlap resistance occurs when price reacts off a particular level from the top and from the bottom. So the more times that it reacts off this area, the stronger the overlap area. So this means that there are more bulls and bears respecting that area. So it's an important area to take note of. So pro tip, if the overlap area lines up with other elements, such as Fibonacci or other graphical elements, then it makes it even stronger. Okay. So you can see from this GIF here, once price breaks out of this swing low support, as we mentioned, it's a pullback resistance. But since price reacts off of that level as well, then it becomes an overlap. So pretty straightforward for overlap, I think. But here are a couple more examples before we get into this week's content. So here we have a swing low support that becomes a pullback resistance once price breaks the support at 105.643. So here we can see how price reacted or retraced back to this resistance level and in fact reversed off of it, making it now an overlap resistance. Okay, so basically, when a swing low and a swing high line up in the same level, it's just an overlap level. And before the point when it forms a swing high, then it's a pullback. Okay, let's carry on. So here we have a combination of the pullback and overlap. So firstly, we have a big swing high resistance level, as you can see first over here. The moment price surpasses the swing high resistance over here, it becomes a pullback support. And you can follow the green arrows over here now. So once price has made a pullback or retracement to our pullback support level and it bounces off of it perfectly, then it becomes an overlap support instead. Okay, another example. So we have two swing high resistances here, right? And then price breaks out of this swing high resistance, making it a pullback support. And the price has pulled back or retraced back to this support level and has bounced off of it twice. So it's a really strong overlap support level. Okay, this is our last example before we get into this week's content. So once again, we're looking at a combination of the pullback and the overlap. So we have multiple swing lows here. It's a swing low support, and then once price breaks the support level, it becomes a pullback resistance. And you can see, since we expected it to pull back or retrace back to that level, it did, and it in fact reversed off of it 3 times. Okay, so at this point, even at the very first point where it reverses off the level, it becomes an overlap resistance. And the overlap resistance becomes a pullback support when price breaks out of the resistance level, and it goes back to being a pullback. And then at this circle, the very last circle here, once price bounces off the level, then it is once again an overlap support. Okay, I hope that was clear. If we have time at the end, we'll look at a couple of charts together, and see how we can combine what we've learned last week with what we're gonna get into for this week. Okay, so let's get started with this week's content. So we're gonna start off with drawing trend lines. So this is how you can draw a valid ascending trend line. Ascending trend lines should be from the bottom and not the top. So trend lines should have at least 3 significant touches. In this example here, I have 4, but 3 is enough. And 2 touches, the reason why we go for 3 is because 2 touches tend to be more coincidental. So we stick to 3. Okay, so here is another example. We have 3 touches on this ascending trend line. And here as well. Okay, pretty straightforward. So I'm just gonna get into the descending trend lines as well. So similarly for descending trend lines, they should be from the top and not the bottom. And trend lines should have at least 3 significant touches. Yeah, same reason, because 2 touches tend to be more coincidental. So here's an example of a descending trend line. In this case, we have 4 touches, but as I mentioned earlier, just 3 is enough. Here's another example. Okay, so take note of how significant or how clear these structures should be, these swing highs. Okay, and then in this example, which is the aftermath of this chart, so when you're looking out for a breakout, for example, we're looking at least 3 significant touches for it to be considered a valid trend line. But you can see over here that price is playing the reaction off of the 4th touch. So it's breaking out of this descending trend line. Okay. Okay, can you guys let me know in the chat if you think this trend line is valid? I mean, we can all agree it's a descending trend line, but let me know in the chat if you think this is valid or invalid. Okay, so this is actually invalid because as we mentioned earlier, for a descending trend line, it has to touch the top and not the bottom. So the bottom is for ascending trend lines. So this is invalid. Okay, so next let's get into drawing trend channels. So channels require at least 4 significant touches, 2 at the top and 2 at the bottom, for it to be considered a valid channel. So they do not need to be in consecutive order like the picture on the right. So we'll look at a couple of examples. Here we have a descending trend channel, and you can see how clear the structures are here as well. Okay, pretty straightforward for that. Okay, let's just get into our next section, which is liquidity traps. So what are liquidity traps? So it's a situation in which monetary policy becomes ineffective in stimulating an economy, even when interest rates are near or at zero. So this occurs when because people and businesses are hesitant to spend their money, even at low borrowing costs, leading to a lack of demand for goods and services. In the context of trading, a liquidity trap can cause problems for market participants as as it may lead to a decrease in market liquidity, making it more difficult for traders to enter or exit positions quickly and at desired prices. This can result in wider bid-ask spreads, increased volatility, and decreased market efficiency. So central banks can try to address a liquidity trap by using unconventional monetary policies, such as quantitative easing, to inject more money into the economy and encourage spending. However, the impact of these policies on financial markets can be difficult to predict and may lead to unintended consequences. Okay, so I've included a graph over here just if you are interested in the economics of it all. But here's an example of how it will play out. Excuse me. Okay, so here we have a nice swing high reversal, and price surpasses the swing high resistance to clear the orders and then drops below the resistance level again. Okay, so in this case, you can see that we mentioned earlier this is a swing high resistance, and price has passed this level, making it a pullback support level. But instead of price retracing it and bouncing off of the level, it breaks out of the level again and drops below the resistance level again. Okay, so here's another example. Here we see price moving within an ascending trend channel and also moving above the Ichimoku cloud. So this gives us a bullish bias. Now at the 1.04791 swing high resistance level, the price drops and reverses off of this level. Okay, yeah, so that's basically it for liquidity traps. Now we're going to see how we can combine all of what we've learned so far when it comes to our trading. Okay, so here's just a checklist of things for you to look out for. So you can find this checklist as well as other tutorials on the Forex Army website. Maybe I'll just show you guys. Yep. So when you search up the forexarmy.com, this is the website that it will bring you to. And there are a bunch of trading guides over here, free trials as well, and trading tools for you to take a look at. So if you're new to drawing Fibonacci's, you can go ahead and take a look over here. The clear market structures gives you a very in-depth tutorial on just the basics and fundamentals of Fibonacci. So there's different examples as well. You can zoom in. You can go ahead and read these at your own time. And some risk management strategies as well, where to place your stop loss, so on and so forth. And support and resistance, which is what we have gone through for the past 2 sessions. And yeah, so you can find that checklist that I showed over here on the Forex Army website as well. Okay, so this is just a good way for you to, if you're a beginner, or even if you're not, this is just a good way for you to see all the different signs and signals that you can use to combine multiple technical analysis methods so that your analysis is more accurate. Okay, so let's take a look at some examples to play the continuation first. So here's another guide or checklist for you to look out for. So firstly, we have, is price respecting Ichimoku? Is price respecting the trend line? Key horizontal support or resistance levels? Is it near any key Fibonacci levels? And where's the next key level it might go? And then we fine-tune with Fibonacci levels. Okay. Okay, so here we have an ascending trend channel with 2 top touches and 2 bottom touches, so we know it's a valid trend channel. Let's see how price will move within this trend channel. So here we are expecting a continuation, and you can see that's exactly how it played out, with price reversing off of the edge or the bottom of the trend channel as well. Okay, so here is another trend channel. In this case, we're looking at a descending trend channel. And in the GIF, once again, you can see this is how we are expecting price to continue within the trend channel. If you're looking for bounce or reversal, what we mean by that is they'll bounce or reverse off of the edges of the trend channel. So this is how we know that price is likely to continue within this trend channel. So once we have that, it's really easy for us to identify a breakout, which is what we're going to be talking about next. Okay, so here is another guide for you to look out for when you are identifying a breakout. So the price crossed below the Ichimoku. Do we have the Ichimoku momentum on our side? The price break any trend line? The price break a recent horizontal level? And the price break a recent key Fibonacci level? In which case we would then check for Fibonacci retracements. And then lastly, where is the next key level it could break out to? In which case we will use horizontal levels such as our pullback and overlap support and resistance levels. And then we'll fine tune those levels with Fibonacci. Okay, so here we have price breaking the multiple swing high resistance area. So we're looking at the bottom level first over here. We have 2 swing highs here. Price is breaking out of this level. You can see at the 125.744 level. So it's typically more of a level I mentioned earlier, but in case you missed it, you don't have to stress too much about it being at a specific level, because more often than not, it's more of an area. So by combining these levels with Fibonacci levels, we can analyze where price could possibly hit next. So in this example, price has reached the 61.8% Fibonacci projection. So for Fibonacci projection, we want to look for kind of a flash kind of shape or lightning shape, if you can follow my mouse. Yeah, so we have the starting point, the middle point, and the ending point as the shape. And then for Fibonacci projection, we used the 61.8, 78.6, and the 100% level as well. But in this case, we are projecting price to break out of the 61.8 and expect it to rise to the next swing high resistance, which is over here. And maybe even to the next Fibonacci level, which is the 78.6. Okay, so this is what has happened. Price has moved above the 61.8% Fibonacci projection level and has risen to the next swing high resistance over here. Okay, so that's how you play a breakout, just solely from looking at the horizontal levels. And also Fibonacci levels in this case. Okay, and another indicator of that price is likely to move upwards is that price is moving above our Ichimoku indicator. So it's also giving us this bullish signal. So with all of that upward movement, we can expect that price is likely to continue to move upwards, which is exactly what it did. Okay, let me know if there are any questions. Okay, all good. Let's move on to our next example. So here we're looking at price continuing within the descending trend channel. So just a recap once again, 2 touches on top, 2 touches below. In this case, we have 3. Okay. And we want to take note that price has recently broken out of this ascending trend line over here. So price is breaking out of an ascending trend line. Firstly, number 1, price is breaking out of the ascending trend line. Secondly, it's continuing within the descending trend channel. And thirdly, it is also breaking out of the Ichimoku cloud, and it's moving below it instead of above it. So all of these signals give us a very bearish bias. Okay, now we take note of the next swing low support, the closest swing low support to where price is currently at. So that would be over here, but that's a bit too close to where price is at. So we're looking at the next level, which is the 1.03488 level. Okay, and we are projecting price to continue down to this level here. Okay, and you can see that's exactly what happened. Price broke out of the ascending trend line and continued downwards to our next swing low support. Okay. Okay, let's take a look at another example. So price recently broke out of our ascending trend channel here. You can see this red highlighted area here is when it broke out. So in this case, we are making use of a Fibonacci extension. So for Fibonacci extension, we are looking for the shape of a Nike tick, which is like this. So in this case, it's inverted. But if you take a look here, you can see where my Fibonacci starts is the head of the Nike tick, or just a tick in general. It's the head of the tick, and then the tail of the tick should retrace back more than 100% for you to use this this Fibonacci method. Okay, so once it retraced 100%, it broke out, and then that's when we can use this. So we took the starting point from here and the ending point here. And for Fibonacci extension, we use two levels, 127.2%, which you can see here, which is where price is currently at, and also the 161.8. And just nice, we can see the 161.8 lines up nicely with our 0.66420 swing low support. Okay, so in this case, once price breaks out of this 127.2, which you can see it did, then we are expecting it to continue to head towards this support level here. Okay, and that's exactly what happened here. You can take a look at this GIF. So you can see price did reverse off of the 127 just briefly, but then it shot back down to the 161.8 and our swing low support just as expected, and then it reversed off of it immediately. Okay, and then one of the reasons why it might shoot back upwards is because of this support level here. We have a swing low that is lying nicely with a 161.8. And in fact, now that I'm looking at it, it seems like we could have an overlap. Oops. I could have pulled this support level back over here as well. And you can see how many times price has tested the level. So you can tell that this level is pretty strong. And it also lies nicely with a Fibonacci extension level. So with all of that lined up together nicely, it's a Fibonacci confluence, which has a lot of resistance at that area. So price is likely to reverse off of it. Okay, let's move on to our next example here. So price recently broke out of this descending trend line. You can see our descending trend line here with multiple touches on the trend line, and then price broke out of it here. Okay. Once again, we are making use of Fibonacci extension. You can see the tick pretty clearly now. This is an upright tick, and price retraced it 100%, so we can use it. And where price is currently at now, it has already surpassed our 127.2% Fibonacci extension level. Okay, so now if we're taking a look at our buy entry, why is it that we placed it over here? It's because we have an overlap level here. We have two swing highs as well as one swing low here. So this is, and price has actually broken out of the buy entry. So instead of, or rather we can see that it's a pretty significant level. But I mentioned earlier that this is an overlap level, but since price has broken out of it once again, you guys know that this is a pullback level instead. Okay, but my point is just that this level is pretty significant and pretty important to take note of. Okay, so we are buying a take profit towards the next level at the 161.8, but we are putting it a little bit lower because if you saw in the risk management webinar, we would place our take profit below any major confluence areas. or before, simply because there is a higher chance that we are going to, or that price is going to hit our take profit level. Because as I mentioned earlier, these Fibonacci confluence areas tend to have a lot of resistance in that area, making price reverse off of those areas. Reverse off of those areas. So in order to make sure that our price actually hits our take profit, we'll place it slightly lower than our Fibonacci levels. Okay, so, and we can also see that at this take profit level, the 85.724, we have a swing high resistance here. And if I can pull it back, I think we have an overlap level as well. Okay, so it's pretty significant, all of these areas, and you can see that's exactly what happened. It broke really nicely off of our take profit and has in fact risen above the 161.8 level as well. Okay, that's our last example for this webinar, but I'm just going to pull out a couple of charts to show you guys how you can combine all of these levels for your trading strategies as well. Okay, let me just pull up my charts. Okay, let me see. Okay, yeah, you guys should be able to see my charts now. So I'm just gonna quickly go through maybe one chart just to show you guys how it works. Okay, let's take a look at excuse me. Let's take a look at USD JPY. Okay, so we will typically start on the higher time frames first, just so that we get an idea of where prices are headed towards. Okay, so this is our weekly time frame, and you can see prices look like it recently reversed off of this swing high, but it's generally moving upwards. Okay, next, our daily time frame. Okay, looks like it's dropping as well. General trend upwards as well. Okay, 4 hours. Okay, on our 4 hours chart, it looks pretty upward as well. Or trend channels. So in this case, I have a ascending trend line with 3 swing lows here. Okay, next, after we've done that, then we'll go in with our support and resistance levels. So your first support, or rather your first resistance, will be at the closest swing high to where price is currently at. So that's over here. So this is just purely based on graphical analysis, but we'll go in and tweak it with Fibonacci levels in a little bit. Okay, so here is my swing low support. Okay, so maybe we'll just briefly go through this second resistance. Okay, so the second support level over here is an overlap support. You can see we have 2 swing highs and 1 swing low here. So it's an overlap support, and for our first resistance, we have 2 swing lows lining up. So these levels are pretty significant. Okay, so now let's go in with our Fibonacci levels. So I'm going to firstly be looking for a retracement. So for Fibonacci retracement, we use these 5 levels: 23.6, 38.2, 50%, 61.8, and 78.6. Okay, so I can see that my 38.2 lines up with my first support, and my 50% also lines up with my second support. So I'm just going to keep those two so it's not too messy. Okay, and then I'm going to be looking for a projection. So as I mentioned earlier, projections, we use these 3 levels. Okay, and I see my 78.6 lines up nicely with my first support and my 100% as well. So I just want to highlight this flash shape here that I'm looking at for our Fibonacci projection. Okay. Okay, all good so far. So we can expect price to continue moving downwards from our first resistance all the way towards our ascending trend line. Okay, and it's likely to reverse off of this trend line as well. Why? And how do we know it's gonna continue within the ascending trend line? Because we have these 2 Fibonacci retracements and projections lining up nicely. And we also have these 2 swing lows here. Okay, so I wanted to move it over here to show you guys that this is an overlap level, but I'm not going to, because if I zoom in here, you can see that I'm cutting too many bodies of candlesticks. So I'm just going to keep it over here with the 2 swing lows. Okay. Okay, now that we've done that, then we'll go in with a couple of indicators to support our analysis. Okay, Ichimoku. Okay, Ichimoku is giving us bearish. MACD is also giving us bearish. Okay, RSI is also giving us bearish. Okay, so we can definitely expect price to continue downwards towards our first support. As to whether it will break out, as I mentioned, it probably won't. Yeah, because of the huge confluence area over there. So there's a high chance that will probably reverse off of the first support or this ascending trend line. Okay, maybe just another thing to note for you guys, before you guys go. We have so this is where our descending trend line on our RSI starts, whereas on our price chart, this is where our price starts to head downwards. So you can see on our RSI, it's kind of a predictor to show you where prices are headed towards. And this is what we call a bearish divergence. So we can expect price to continue to move downwards because of all the downward pressure. Okay, that's all I have for you guys today. Let me know if there are any other questions that you guys have. I'm happy to stay for a few more minutes if you guys have any questions. If not, you guys can leave. Thank you guys so much for joining me today and have a great rest of your week. Bye, guys. Fundamentals is super important. So, we will look at we'll look at okay, let me show you. So we use Forex Factory to look at all of the important announcements for the week. So you can see here. So I will normally only look at the red calendar events. But I know a lot of people prefer to look at these as well. So we'll look at, okay, if you're talking about Japan, yeah, we will follow these as well, like all of the forecasted previous results as well. Yeah, not just technical analysis. Yeah, for sure. If you are trading Forex, it's super important for you to take note of any announcements as well, because it really affects. Okay, no problem. So let me know if there are any other questions. If not, you can feel free to leave. Okay, if technicals and fundamentals are giving you opposite signals, it really depends on the context of it. Um, yeah, because even using technicals, sometimes, for example, if I'm using an indicator, there are so many indicators, 50% of them will give you a bullish signal, 50% will give you a bearish signal. So I tend to listen to the fundamentals more. Yeah. Yep. If you're talking about short-term trading, like if you are scalping, then that definitely could be one way to do it. Because in these webinars, we're typically not looking at short-term trading. We like to look, since we're trading on either the 4 or 1 hour, we're looking at a longer time frame. That's why we don't really take into account the candlestick shapes. Yeah, because those tend to fluctuate on a longer time frame. Yep, for shorter time frames, that definitely will make sense. No worries. Thank you guys so much for joining me today. Hope you guys found it helpful. Okay, see you guys next week. Bye.